Road to Goldilocks. On December 13, 2023, the Federal Reserve Chair Jerome Powell signaled a pivot towards a more accommodative policy, maintaining the federal funds rate but suggesting potential future rate cuts. This pivot, prompted by declining inflation rates and a softened economic outlook, fueled market optimism with predictions of multiple rate cuts in 2024, causing market interest rates to drop and stock markets to rally. However, achieving core inflation consistently at the 2% target remains a challenge, necessitating cautious policy adjustments to avoid deflationary risks. In 2024, the Federal Reserve is expected to begin lowering the federal funds rate, leading to decreased short and long-term interest rates. This will likely stimulate corporate earnings and economic growth as lower interest rates ease consumer and business burdens and improve corporate financial performance, thereby boosting the stock market. Despite the market's positive response to the Fed's policy shift, a depreciating dollar due to lower interest rates could lead to increased import prices, affecting inflation. International oil prices, influenced by geopolitical events and OPEC's production decisions, also remain a variable impacting U.S. inflation. A balanced approach is needed to manage these external factors while fostering a soft landing for the U.S. economy. As the labor market cools off with a slight increase in unemployment and a decline in wage growth rates, signs of a softening economy emerge, which is necessary for a gentle economic slowdown or a soft landing. However, these trends need to be more pronounced and sustained to significantly impact structural inflation. Despite initial forecasts of a 2023 recession due to rapid Federal Reserve rate hikes, the economy has shown resilience, with inflation gradually decreasing. The December FOMC's halt on rate increases indicates a shift towards potentially reducing rates, offering a more optimistic outlook. However, balancing the speed and extent of rate reductions is critical to prevent market overheating or excessive cooling. The Federal Reserve has tools to counter potential economic downturns, including adjusting the pace of quantitative tightening or decreasing interest rates when necessary. Close monitoring of the 10-year Treasury yields, China's economic performance, and global geopolitical risks is essential as these factors could significantly influence the U.S. economy's trajectory in 2024. Overall, experts predict a moderate growth rate for the U.S. in 2024 with a consensus towards a successful soft landing. Rate cuts are anticipated in the latter half of the year, contributing to a cautiously optimistic economic outlook, albeit with global and domestic uncertainties that could impact economic conditions. As 2024 progresses, the Federal Reserve's monetary policy will be pivotal in steering the U.S. economy towards sustained growth and stability.